Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time and get to our first stock today. My colleague Nigel gets us this very special deep dive on Gateway Distriparks.
Gateway Distriparks is an integrated intermodal logistics service provider, and it has a network of 10 inland container depots and container freight stations. They operate a fleet of 31 train sets along with 500 trailers for transportation between its facilities and maritime ports, as well as first and last mile connectivity to provide end-to-end solutions to the XM industry. While the company offers general and bonded warehousing, rail and road transportation, container handling services and other value-added services. Well, they have three big businesses: the CFS, ICD with rail movement, and the cold chain storage and logistics, which is housed under the associate company, Snowman Logistics. Well, a quick check on the financials so far in this year shows that the top line there has been some growth with stable margins. But further looking into the segmental breakup shows that there has been growth in the more profitable ICD business, while there is some degrowth in the CFS business. Valuation-wise, though, there is some comfort on the stock. It trades at around 11 times EV upon EBITDA. The promoter entity has 32% stake in the company, but there are various large institutions that hold stake as well. Their balance sheet is comfortable with net debt at around 300 crores, though they are in process of finalizing plans for additional 2 terminals. We'll have to watch the capex on that front. The key parameters to track from here on are asset monetization in the CFS business, the scaling up of the core ICD business, and understand what are their plans with Snowman Logistics. Well, let's get straight to Mr. Prem Kishan Gupta, who's standing by. Well, thanks so much for coming on CNBC-TV18, Mr. Gupta.
Hi Nigel, welcome to our ICD in Gali Hasru, Gurgaon, which is the flagship of the company.
Well, talking about the flagship of the company, we are here in Gurugram.
Yeah.
And this is one of the largest ICDs, or is the largest and one of the most profitable for you.
Right.
But I believe there's a backstory with regard to the origination of the name Gateway Distriparks. Take us through that first.
Yeah, see, as an importer, I was facing hardship in getting the containers cleared and everything. The infrastructure was not there. So we envisaged a CFS of our own in Mumbai, Nhava Sheva. And sitting at Taj Kolaba, we were looking at Gateway of India, and then we thought of the name of the company as Gateway. And why Distriparks? Because in many countries, the ICDs or the logistics, they are called as distribution parks. So we made a short of it, Distriparks. So
Well,
Gateway Distriparks was formed 30 years ago in January 1994.
Well, that's an interesting backstory, sir. But let's get to business then. And before we start talking about your company, in India, we have that rail-roll mix, and it's expected to move in favor of rail.
Yeah.
So could you tell us what is the current mix? And post the commissioning of the DFC, how do you see that mix changing? Because there is ample room for rail to garner further market share.
You are right. Rail at present is approximately 27% share of the market between rail and road. And it is our assumption, going by whatever infrastructure improvements are going, like the DFC, we expect it to go up to 45% by 2030. And that's where we are working towards expanding our ICDs, the existing ones also, and even the new ones. And the DFC to Mundra, Pipava is already there, but some strengthening of some sections are to be done so that it will increase the speed and the load factor.
Yeah.
And the JNPT is expected to be operational by end of this calendar year. So that will boost up the double stacking to JNPT as well as the speed and volumes from road to rail.
Well, Mr. Gupta, you've given us a sense about the backstory as well as industry dynamics. Let's talk about your company now. Out of your total ICD capacity, what is the current utilization levels? And also, what is the market share in areas that you are present?
Okay, so we have a capacity of about 700 to 710,000 TUs per annum.
Yeah.
And we are at 50% utilization at present.
Okay.
And we are expecting that the volumes will go up once this DFC is completed. And the market share in the NCR region is about 16 to 17%. And in Ludhiana market, it is about 22%.
Could you see a double-digit volume growth for the
Yes.
coming fiscal, that's FY25?
Yeah, if you don't count our new ICDs, then it will be 10%.
Okay.
But it will be more than 10% if other ICDs like Jaipur, it is a bit delayed, but we see it very clearly that we will have some operations starting in FY26.
In FY26?
Yeah.
So you're expecting the Jaipur land issues, everything to get sorted out, and you'll see incremental volumes coming out of there for FY26. Are
Right.
we getting that correct, sir?
Right, absolutely right. And at the same time, we are looking at 5-6 different locations, and out of which I'm pretty sure that within the next 1 year, we will finalize the land for 2 locations at least.
So in your ICD, that's your focus, that's the bread and butter, that's the profitable part of your business, because CFS is declining, which we'll get to that in a bit. But for your ICD, since you're looking at different locations, what is the rough capex that you have earmarked for Jaipur and for these new locations that you're looking at?
See, Jaipur, we have already spent about 30 crores.
Okay.
And we will be spending another 50-60 crores to make the ICD operational. And for the new ones, we are looking one of the similar capex about 100 crores, and we are looking a slightly bigger one at another location, which will be about 200 crores.
So give and take everything, for 2 new locations as well as Jaipur, you'll be spending an incremental 250 crores.
350 crores.
350 crores all put together.
Right.
Got that. Let's also focus about other parts of your business then. As of now, I believe that you're focusing more on EXIM volumes, and domestic is not a large part of it.
Right.
Will you look at changing that mix a little bit more towards domestic, or do you believe that since it's more profitable, you rather stick to EXIM volumes?
So we will stick to EXIM volumes for the time being, unless the transit times to the domestic areas, which is mainly the long distance from north to south or east to west. So we are not looking at having any terminals in the near future.
Okay.
But yes, once these DFCs on north, south and east, west are operational, we will definitely look at domestic, but that's a long haul.
The key matrix for you is the EBITDA per TEU.
Right.
And currently it's around that 9,500 to 9,800 rupees per TEU.
Yeah.
Do you believe it can hold at current levels? You'll be getting some operating leverage that will play out as well. So do you think that around 9,700 a year about, that's the number we should work with for FY25?
Yes, we are rather targeting 10,000.
Okay.
And the reason is that because of the DFC of being fully operational, and double stacking will go up, and turnaround time will be much better than it is today.
Okay, so there is an upside to this. You think
Yes.
that there is limited downside to this metric at least?
Yeah. Actually, we have prepared ourselves for the growth in
Yeah.
business, in the EXIM, and container volumes, what we talked about rail and road.
Yes.
And the best of Gateway is yet to come on the rail side.
Oh, that's what you believe?
Yes.
Okay, but no, there's going to be another big competitor. The largest player in the market is Concord.
Right.
And in all probability, if there is a possible privatization, then you're going to be having a far more competitor, so to call it. Because there could be a private player that comes in there.
Right.
Do you think the industry dynamics change? Do you think it will be a challenge to your business?
Not really, because if you look at it, Concord is competing with us today, but it's only in Ludhiana market.
Okay.
The locations where we have our ICDs, they are not a competitor to us even today. And whosoever the private player comes in, he will come at a capex, to buy Concord share. And it is not easy for anyone to invest that much and then compete. And already the competition is there, so we are already competing.
So you don't see it as a risk. You believe that both of you can prosper together.
Right.
But there could be another player who may want the asset, because there'll be quite a lot of bidding for this Concord asset.
Yeah.
And if they don't get lucky and they don't win Concord, then suppose they say, Mr. Gupta, I like your business. You're a smaller player, but with great growth potential. I want to sign a big check and give you. Will you look at selling out the ICD business?
Well, confidentially, some, I would not name them, but people have already approached us and we have said no.
So you're keen on running the business?
Yes.
Irrespective of the check size, you will run the business?
That is our business, and the succession plan is there. The 2 joint managing directors, my 2 sons, are already into business for more than 10 years. The elder one being in business for now 15 years. So we have put in all our eggs in this basket, that the Gateway business should it will be a story for another 25, 50 years in the Indian context, you know.
Well, Mr. Gupta, the other part of the business is the CFS business, and there's not a lot of focus out there because we know that the industry dynamics itself have changed. So give us a couple of numbers. Do you expect the CFS business to improve from here on, and has it bottomed out on an EBITDA per TEU?
Well, I cannot say whether it is bottomed out or not, but this is the lowest ever EBITDA margin per TEU that we have got.
Okay.
And we can have some slight improvement, but I don't see in the long run that CFS business is going to make a good or nice contribution to our business.
Well, anyway, the street is not expecting too much in terms of revenue, EBITDA performance.
Right.
But what they're focusing on is on asset monetization. And you've mentioned in the past that that is the goal. You're looking at some of these assets and you're looking at monetizing it. So could you tell us which are the assets you're looking at monetizing in the near term? Say FY25, FY26, which are the ones you target?
See, the process is already on.
Yeah.
And we have got some valuation for some of the land parcels that which are not being utilized. And we expect some closure maybe in this financial year, a small closure. And it will be an ongoing process. So we will sell it at the right time, at the right value.
So which asset goes first? You have various assets in South India, you have an asset in Mumbai. Which one should we focus on?
I think Krishnapatnam is the one which we are trying to do first, because the throughput of containers is very minimal.
Okay.
And we don't expect the container volumes will go up in that region. So we have progressed on that, and that will be the first one to go. And simultaneously, as I said, we have some land parcels in the south also, which are not utilized and which we have kept for a long time. And we will sell it at the right time. So in the next, say if you say by financial year 26, it will be in the range of 150 crores that will reach.
150 crores of asset monetization is on the cards in the next 2 years.
Right.
That's FY25 as well as FY26. And you're hinting that maybe some part of it as well could probably get squeezed into FY24.
Right.
Got it. All right. So we have got that down with regard to the CFS business. Let's focus on Snowman.
Yeah.
That's turned around and turned around in style.
Yeah.
What are your plans out there, Mr. Gupta? You've gone ahead and increased stake by, by around 3.5% approximately, or 4% roughly.
4.5%, yeah.
4.5% in this fiscal so far. And your holding is in the mid-40s.
Right.
Do you plan on going the whole hog and maybe going to the halfway mark that's towards 50%?
We would like to keep it in our fold. And this year we have bought about 4.5% so far under creeping acquisition. We will buy some before the end of the year. And if the cash flows at Gateway level are good enough, we will continue that next year and make it a subsidiary rather than an associate company.
So probably by the end of FY25, you'll have Snowman's numbers that will consolidate, because it won't be an associate company around. In fact, it'll be a subsidiary.
We hope so.
Okay, got that. The problem with Snowman is, though there's big revenue potential and there has been fairly good margins, but the return ratios are a little bit subdued. So could you tell us, from this single digit or mid-single digit, where do you see the return ratios improve?
See, there's a change in the strategy now. Earlier, everything was owned by us. So there are some land leases, but most of the assets of the cold store, and which have very high depreciation also. But lately, we have shifted the model to asset light, and there will be some ownership also, but a mix of those two will bring it into double digit.
That the ROC goes to double digits?
Yes.
Is that what you're telling us?
Yes.
In the next couple of years?
Right. Because whatever new facilities we are bringing up in Snowman, that will have a ROC of about 14 to 15%. So that will make the average, for the previous years to a double digit going forward in the next 2 years.
Just to clarify, on Snowman, you're looking at taking your stake to around 50%, and there are no plans on selling this asset as of now?
No plans to sell, and 50% we aim to do that.
Well, Mr. Gupta has given us a fair idea about the segment-wise breakup. But to feel the way ahead, we have Gen Next who joins us, the joint MDs of the company, Ishan as well as Samvid. You know, Mr. Gupta has told us about guidance for the individual sectors. But Ishan, let's come across to you first. What is the revenue growth we're looking at from here on? And margins have been in the vicinity of the mid-20s. What do you expect it to be going ahead?
So we're almost at the close of this year and we expect to cross 1500. Going ahead, we expect 10 to 12% growth in the gateway business. And we see a lot of levers kicking in the future. So currently our margins are hovering around 25%.
Okay.
We don't expect this to go down at all. And as soon as the DFC kicks in and we have longer stretches available to us, we will improve further on the margin side. And then in Snowman also, currently we're at 500 crores we're targeting for this close of this financial year. And by 2026, FY26, we expect to close around 1,000 crores revenue. That all guns are blazing for that. And let's hope that we achieve that.
Got it. All right. So for the consolidated entity, we do have the numbers both on the core business as well as on Snowman. Samit, let's get you in. You know, Mr. Gupta said that he has a capex of 350 crores. The current debt in the books is also around 300 crores roughly. But he's also talking about asset monetization. So my question to you is, what is the peak debt levels?
Right, so currently we have a net debt to EBITDA of 0.7 in both the companies, and it's quite comfortable, especially with the monetization and increasing revenue and profit. So a peak debt will probably go to 400 crores, which would be about 1:1 net debt to EBITDA.
Got that. All right. So good to see that the next generation as well is involved in the business. But Mr. Gupta, some part of the street says that it looks more like a family-run business, not a professional business. What's your comment to that?
Look, I am the first generation entrepreneur. And after that, I mean, they both are joint managing directors, and they act professionally, and they have their roles, and they are very active in the business. And we have the head of businesses, you know, for rail also, for CFS also, and for Sunil, you know, is CEO of Snowman. I wouldn't agree with this statement that it is family run. It is professionally run. We don't look into day-to-day affairs, but we are on top of it.
Okay.
That is what I would like to sum up. So I want to allay the fears that we are sitting there and, you know, dominating the business. No, it's actually run by people which are at every level, whether finance or IT or operations, everywhere.
We'll take your word for it. It's been a pleasure talking to you, Mr. Gupta. And thanks so much, Ishan, as well as Samvid, for joining in here on CNBC-TV18.
Thank you. Thank you very much.
All right, that was a deep dive into Gateway Distriparks, but time to slip into a short break. DCX Systems, that is the stock in the spotlight on the other side.